How to identify liquidity, the different forms of liquidity, and how I use it to generate tens of thousands of dollars of profit every single month. With that said, let's dive straight in. I'm going to explain the 3 different forms of liquidity, and after that we're also going to be doing a trade breakdown. So the first form of liquidity are, very simply said, swing highs and swing lows. And what we expect is that underneath or above a swing high or a swing low lies liquidity. And liquidity is pretty much just the assumption that there are stop losses resting above or below a high. So what I'm going to do is I'm going to dive into this piece of price action over here, and what you can very clearly see is an impulse down. Now in that impulse down, what you have are little bumps within the road of the market moving in towards the downside. And what you want to do is you want to mark out the highs of those so-called bumps within the road, because what you see is that if you mark out those highs, every single time you come above a high, the market tends to react in towards the downside, as we can see here and as we can see here. Now, there is a big difference between this high and this high over here, and that is the fact that over here, the order flow is sustained. So obviously we see a reaction in towards the downside, but this overall sell before the buy, which I classify as an area of demand, causes the market to push up higher. You could also classify this as a so-called fair value gap. Now over here, what you see is that the market as well reacts. However, it denies this so-called fair value gap and it breaks structure over here. Therefore, you see the impulse down, the pullback, and then a downside continuation, validating this swing high over here. So again, what you see is just the difference between the two, but then again, a reaction is always caused above these so-called highs and lows. The second form of liquidity is so-called range liquidity, and this is a pretty easy one which you've probably seen many times. Now, when we have an area of consolidation, there is an assumption that there's again stop losses resting below and above the range. Because what a lot of traders are doing is that they're looking to trade the overall breakout and go long once the market breaks out of that area of consolidation with their stop loss below the overall range on the other side, or what they tend to do is to trade the overall break retest. Now, what you need to understand is that there's liquidity, or also known as stop losses, resting below and above the overall range. So what you want to do is, again, when you identify an area of consolidation like we have here, is you want to mark out your swing high and you want to mark out your swing low. So this is the swing high of the range, this is the swing low of the range, and what you see, again, as soon as you get above the range, the market moves in towards the downside. As soon as we go below the range over here, the market reverses in towards the upside. And what you can simply do is that once the market pops below the range low, is you just transfer that low to this low over here. Then again, we pop below the range, and then the market tends to reverse back in towards the upside. The third and the last form of liquidity is so-called trendline liquidity. And obviously we have ascending and descending trend lines. So what we have here is a descending trend line in towards the downside. And what we have here on the right is a ascending trend line in towards the upside. And again, what you assume is that there's just simply said stop losses above the high of each trend line touch. And again, when in an uptrend, you suspect that there's stop losses below the low of each trendline touch. And eventually what you expect the market to do is to reverse and take out all those stop losses, because a lot of retail traders tend to put their stop loss below the low or below the previous low of that trendline touch. Now, I'm going to give you guys a trade example showcasing this exact strategy in works. So what we can see here is entity USD being bearish in towards the downside, giving us a correction, and we're obviously looking for further downside continuation. Now, what you can very clearly see over here, and I'm just going to press the replay tool, is what happened that we pushed in towards this area of supply over here. And again, this supply zone was created by taking out liquidity over here to our left. So therefore, this is a so-called sweep zone, or a so-called extra strong area of supply. Now, after providing us with that initial reaction, obviously we see some push in towards the downside. Now, we know this is a strong area of supply, but to additionally validate that we want to be looking for a short here, I'm going to be looking for a form of liquidity. Now, what we have here is so-called trendline liquidity, because we can very clearly see that we have an obvious descending trend line creating resting lower highs. Now, this is trendline liquidity, but you could also identify this as swing high liquidity over here, as this is a bump in the road down. What you see is that this high tries to take out the high. This high also tries to take out that high. They fail to do so. So there's a lot of liquidity being built up above that high. Now that I understand that the overall market structure is bearish in towards the downside, we have liquidity above this high, which is both, let's say, a swing high liquidity, but also trendline liquidity. I'm ready to look for my short. So we have market structure, we have an area of supply, we have trendline liquidity. We're also in good value in the sense that this is your overall, let's say, swing range. We're inside premium, we're above the 0.5 fib. So I'm looking for that short. Now, to validate this potential short, I then go in towards the market structure. I'm looking for a so-called market structure shift. So what you see here is a change of character high. The change of character high gets broken by what low? The low of this bullish candle over here. So to me, or for me, this validates this as an area of supply. I'm therefore happy to go short on top of that area of supply with my stops above the highs. Now we zoom out, and again, what do you see happening is that you pretty much see again trendline liquidity being formed here. So what happens is that we have a low or swing low over here, and we have this low, we have this low, and we have this low. So these are, let's say, the higher lows, right, which are forming on top of the trend line, and there's again liquidity resting underneath those lows. So those are the lows that are going to be target. So if you trade trendline liquidity and you're targeting trendline liquidity, that is then also the low that you want to be targeting. So what you see is that we get entered over here on this supply zone, which was created through trading from this area of supply and grabbing the liquidity above that trend line. We then push in towards the downside, and what you eventually see is that the market continues in towards our take profit level, and that is how to take trades in combination with liquidity, to identify the different forms of liquidity and how I use it myself to generate tens of thousands of dollars every single month. Now, if you enjoyed this video, make sure to leave a like and join the Discord community, link in the description down below. I hope to see you there. If you have any questions, let me know, and thanks for watching.